Look, dealing with money stuff after someone passes away is, well, it's just awful. So today, we're going to cut through the confusion and answer a really stressful question. Are you on the hook for a family member's loans after they're gone? Let's get right into it.
So this is the question, right? The one that hits you when you're already trying to deal with so much. When someone you love is gone and they've left behind bills, a credit card balance, maybe a mortgage, who legally has to pay up?
Getting the right answers here, this isn't just about the money. It's about giving yourself the headspace to actually grieve without being crushed by financial worry. So let's walk through this step by step.
All right, so here's the number one thing you absolutely have to understand. Think of it like a legal firewall. It's a protective barrier set up by the law, and it all revolves around one key thing, the estate.
So, what is this estate thing exactly? Well, it's pretty simple, really. It's all the stuff the person left behind, their cash in the bank, their house, any investments. The key thing is to think of the estate as its own person, its own financial entity. And that entity, the estate, is responsible for the debts, not you. And here's how that firewall actually works in practice. The bank goes after the estate first, not you. Your personal money is separate. Now, as an heir, you might have to use some of the inherited assets to pay off that debt. But, and this is huge, you only have to pay up to the value of what you inherited, nothing more. And if there are no assets, well, in most cases, the bank is just out of luck.
And this visual? It just shows that firewall perfectly. See how the estate is standing right there in the middle? It's the shield between the lenders and the family's personal savings. That protection is so important.
Okay, let's break this down with some real-world examples. First up, the big one everyone worries about, unsecured debt. We're talking credit cards and personal loans. The whole game changes based on one little word, collateral. Unsecured debt, like that credit card balance, it's not tied to anything specific. But secured debt, well, that's attached to an actual asset, like a car or a house. And that makes all the difference in how a bank can get its money back. Okay, here's a super common situation. What if you were just an add-on card holder on their credit card? Good news. You are not on the hook for the debt the main cardholder racked up before they passed. But, and this is a huge but, you have to stop using that card immediately. Seriously, any purchase you make after they've passed away, that's on you, and it could even get you into hot water for fraud.
All right, so that's unsecured debt. Now let's flip the coin and look at secured debt. Think home loans, or maybe a loan against a fixed deposit. With secured debt, the bank's playbook is way more straightforward. First, they look at the asset that's backing the loan, the collateral. That's their target. So if it's a home loan, yeah, they can start the process to auction the property to get their money back. If it was a credit card secured with a fixed deposit, they can just take the money right from that account.
But, and this is so important, their claim stops there. It ends with that specific asset. So even if the house auction doesn't cover the entire loan, they can't come after you personally for the rest. Their recovery is capped by the value of that collateral, period. Okay, so we've spent all this time talking about this awesome legal firewall, and it is strong, but it's not foolproof. There are a couple of very specific scenarios where that firewall gets breached and you become personally responsible. You need to know what these are. All right, this is it. I need you to listen really closely right now. This is the exception that can change everything for you financially. So, when are you on the hook? It really boils down to this. Did you sign the loan agreement as a co-borrower or a guarantor? If you did, that's a binding contract. That debt is now yours. And here's another really critical distinction. Just being a co-owner of a house doesn't automatically make you responsible for the mortgage. You have to be a co-borrower on the loan itself. And this right here says it all, black and white. If you co-signed or guaranteed that loan, you're responsible for the whole thing. There's no gray area here. The responsibility shifts directly to you. Okay, phew, that's a lot of information, I know. But understanding the rules is only half the job. Now, let's talk about what you need to do. Let's build your action plan. Your very first step, before you do anything else, is to notify every single bank and lender. Get them a copy of the death certificate. Why? Because this freezes everything. It stops the penalties, the late fees, the crazy interest from piling up. This one simple act can save you a world of hurt down the road. So for credit cards, here's your checklist. Get the death certificate. Of course, that's the main thing. Write a simple, formal letter to the bank.
Have the credit card number handy, and maybe the latest statement if you can find it. Just getting this stuff organized is going to make your life so much easier. Now for personal loans, the list is pretty similar. You'll need the death certificate, proof of who the legal heirs are, but here's a big one to look for: insurance documents. A lot of loans have something called loan protection insurance. If you can find that policy, it might pay off the whole loan. That's the best case scenario right there.
You know, none of this is easy to talk about, let alone go through. But having clarity, knowing the rules, and having a plan, it gives you back a sense of control. It gives you the power to move forward with confidence.
And that really brings us full circle, doesn't it? After you've gone through all of this to settle a loved one's affairs, you can't help but look at your own. So the real question I want to leave you with is, now that their house is in order, how about yours?